Welcome to the Growth Game podcast, live from Austin, Texas. Welcome back, guests. Well, we have a friend of the Growth Game podcast here. Patrick, thank you so much for returning.
I am always happy to be here.
It's great. Well, we got to do this last year, I think it was, right?
Yes, very spirited conversations, which I appreciate.
It was super fun. Yeah. So thank you so much for coming back on. I guess it meant that we didn't run you away.
That's exactly it. That's exactly it. As opposed to somebody like grabbing me as I'm walking down the aisle.
Exactly. Well, thanks for coming back in. I appreciate it. As you know, my audience always wants to hear about growth and how to pattern match and how to, add value to their business. And one of the wonderful things, being good friends and of the podcast and definitely outside of the podcast as well, is what I love about what you do is you've got this incredible insight into what's working because you're helping buy and sell companies.
Yeah, I appreciate the buildup on that, but hopefully the insight is just coming from number one, the number of transactions that we do, and the fact that we're students of the game. So
I love that, and I appreciate that about being students of the game, and that's actually part of the fun of it. I think of what we do. Yeah. Like it keeps us coming back.
Yes, it's true. It's if you're going to try to be good at something, go ahead and at least dive in and understand what's coming. Right?
Yeah.
Learn, read, listen to other people, listen to competitors, listen to anyone. So.
I love what you just said about being good at something. Somebody just asked me the other day, they're like, why are you still at this so hard and working so hard in this business? And it's because my golf game sucks.
See, and I look at it and I say, there's a couple of things that I love. Number one, I love M&A.
Yeah.
Right? I love what we do. Love mergers and acquisitions. I love the idea of building companies and being able to turn them into liquidity events for founders. Feels great to do it. Yeah. I also like skiing, right? And now my kids are grown, gone. So I have nothing better to do except for M&A and skiing, and that's it. So
bravo, I love it.
Right?
I love it. No, I kind of feel the same way. No, and I'm passionate about my business as you are, and I appreciate that does. It keeps us coming back. I mean, the fundamental of what we're doing for people is we're legitimately changing their lives and their family and creating generational wealth.
Yeah.
That is impactful for not just them, but for the things that they give back to. It's pretty. It's enjoyable to see that part of the aspect of that we really are giving people something incredible that does make a difference in the world.
It's even if you take a look at the mission of our firm, Transact Capital, right? Our firm's mission is to give people choices, and what we're talking about in terms of founders is to be able to say, when they go through a transaction and they're able to put their hands in their companies in someone else's hands, they have choices of what to do with the rest of their lives because they have a liquidity event that gives them options. And that's really fulfilling. And it's also not just options for the founders themselves, but for their progeny, for their kids, for their kids' kids. If you're going to spend 20, 30 years building a company, if you're going to spend 5 years building a company and have an exit strategy that goes along with it, let's at least have a butterfly effect of having a positive impact down the road.
Yeah, totally makes sense to me. Well, certainly you told us this last time that you were on, but just give us a quick reminder of how you got into this business and how you got here.
Yeah, so coming out of school, I used to work for General Electric. And then right after that, I went down to the street. I loved the business, didn't necessarily like the people with whom I was working. So ended up going ahead and working with some other companies that we eventually built and sold. We had a number of those. But I always had the calling to come back into investment banking, and in 2011, I made that decision. And specifically coming into the staffing space, it was a choice because I saw that there was this vast market of founders that were trying to create economic events, but there was no real concentration of investment bankers or advisors in the space at that time. And so we made a choice to come into it, and it is probably one of my favorite industries that we serve. Because it's the quality of the people and the fact that the staffing industry is the mortar between the bricks of the economy, and lives change because of a job. And as a result of that, what this industry does is critically important.
Yeah, I agree. It's impacting people every day. People are literally putting food on the table because of what our clients are doing, right? And that's, I really enjoy that. Putting people to work and being able to impact people in that way, and then being able to see entrepreneurs that maybe even come from very blue collar backgrounds and be able to create some wealth for themselves. It's very enjoyable. I enjoy it.
It's a remarkable thing because if you take a look at some of the most successful staffing companies in this country, started off with a welder who, just was able to build his own thing, or started off with a warehouse worker who said, I could do this as well. Now they grow pretty substantial companies, and it's very gratifying to be able to help them, find their moment.
Love it. You're an international traveler. I know you love travel. Talk to me a little bit about some of your fun travel, but specifically, how does your travel affect you and your personality, and how does that really kind of relate to what you do in your work?
You know, the travel is really important. And it was funny because I think it was Twain who said, travel is the death of prejudice, right? And it allows you to kind of see the broader view of the world. There's an empathy when you travel globally. And recently, I've been to France, Estonia, got a trip planned to Kyrgyzstan, been down to Colombia in the last year, and some of the, some more far-reach places. But when you start getting involved deeply in other people's cultures and you just get to be an observer to it, right? There's a level of understanding of empathy and sympathy that goes along with saying their lives are different than my life. And I want to go ahead and understand what their situation is, what their food is, what the way they live is, or their customs or their laws or other things. So I do actually a pretty deep dive before I leave for that country. Now you take that and you apply that to mergers and acquisitions, and you say, well, here is this company, they have a corporate culture, they have ways to communicate in and amongst the group, they have strategies, they have, different economic levels. And so the understanding that I get from world travel, you bring into an M&A situation, and it allows you to be a lot more empathetic and have a greater understanding of that which you are representing.
Yeah.
It's added a tremendous amount of value. We encourage it in our firm, too, for our guys to also travel a lot.
I love that. And I love the fact that it does bring down barriers. Excuse me. It also allows you to kind of approach life as a constant learner.
Yeah.
And not just as a constant learner from the outside, but actually kind of getting your hands dirty, get in there, actually understand it. Because if you don't truly understand what's happening in a business that you're selling and understand the culture, you're really not going to be able to have a good outcome, right?
Yes.
You got to make sure you match. I mean, in the end, really what you're doing is sophisticated matchmaking.
Yes. So this is it's very true. It's so true. And when you go to AI, something that's really interesting that's happening right now, and it goes to your point of being a lifelong learner, right? As you know, I don't have a television in my house, so we read an awful lot. But a lot of people are trying to use AI to do things for them. It's interesting when you turn that on its head and say, what can AI teach me about a subject? And just have the conversation with AI about any subject matter that you're learning. And that lifelong learning is what really adds value to other people's lives, because you're able to synthesize some outside influences into a salient point for the individuals to help them through a problem or something else. If we used AI as a teacher rather than as a secretary, I think more lives are going to be fulfilled.
Yeah, I completely agree with that. And that's a lot of the way I'm really been using it as well. And it's truly impactful.
Yeah. Yeah, it makes it is not the panacea. It doesn't solve everything, Paul. But what it does do is it allows us to concentrate that knowledge and get a greater understanding of the situation around us. Lifelong learning and analysis of things that are foreign to us.
Completely agree. Well, that's great talking about travel and how it impacts really what you do. And I love it. I mean, I can't wait to travel every single, a couple times a year to be able to have that extra time to be able to recharge and understand. So it's really great. Let's talk.
It's also, remember we also just finished doing a deal in Brussels. We're in the middle of a deal in Hong Kong. We're about to do a deal in Estonia. And what's lovely about that too is that fulfillment, it helps us broaden our reach within the world. And you're gonna really appreciate when you start to study to realize that the world is much more accessible in a shorter period of time than you realize.
Yeah, I love that. Very cool. Very cool. So let's talk about buyers a little bit.
Yeah.
What are buyers looking for?
Yeah. So buyers come in broad categories, but let's think about this, and we'll talk about it in terms of like private equity or strategics, right? Private equity being the financial type buyers, they're coming into a market, they're trying to expand on one, or strategic, somebody who's already in the industry itself, and they're looking to add to their growth. So the first thing they look for, some sort of strategic fit. Mm-hmm. Where does it come in? Because otherwise we have Tinker Toys and Legos and erector sets, and none of those really play well together. So there's got to be something that goes within that. But they're also looking for structural fit, they're looking for strategic fit, and they're looking for financial strength. And if it's not currently present, do they have a solution to the formula by which they can fix something and move on from there? But once you start peeling it all back and you understand, the buyers understand, okay, this is the company, its position, and this is what it has, it starts then looking at really 5 fundamental things. What's the strength of the management team and how can we leverage them? What's the strength of the financials and what can we do to be able to leverage that? Does the customer base look like? And it is a solid customer base? Is it on solid ground? Are there customer concentration issues? Are there change of control provisions that would keep that from happening? And can we take that current customer base and apply it to the rest of our platform? They're also looking for at least strategic outlook, a couple of years. Where does this company see itself going? What does it want? Does it have its own vision? Can we plug it into our vision? And is it through technology and everything else poised for the future? And then lastly, how solid is the company from an operating perspective? Does it actually have things that we can use to elevate our competitive position? Yeah. But ultimately, all buyers are looking for ways to be able to increase their competitive stance.
Yeah, that's great. And that helps, I think, many of our companies think about, many of our audience think about kind of what they're building and, do they build something that can actually fit in? Like, I love the analogy. You can't just actually take a Tinker toy and say, I'm going to put it in with a Lego set. That's a really great analogy because, and I agree, businesses come in those different flavors. Like they really do have their own nuances.
Yes.
And if you don't match it up correctly, like I said, you're kind of a sophisticated matchmaker, but if you're not matching it up correctly, you're going to have a bunch of unhappy people.
Yeah. And ultimately, I mean, McKinsey did this study years and years ago, and they said that 85% of all M&A fails to be accretive, right? It doesn't fail, it just fails to be accretive or as accretive as they projected. And you have to ask yourself, why is that? And it's because in the due diligence on the front end of things is that the considerations to culture, the considerations into process, the considerations into creativity and the way that things are going to progress going forward weren't thought enough, were not well thought enough there. And so there, everybody does an M&A transaction and goes, oh, we didn't really get out of it what we thought we would get out of it. And that's a tough place. Lincoln Logs, Tinker Toys.
Yeah. So let's talk about EBITDA.
Yeah.
Would you define it for our audience?
Sure.
One thing I can't stand is just expecting that everybody knows what it is. Yeah. But define it for our audience, please. What is EBITDA and how important is that to what you do in your work every day?
So EBITDA, it depends, it goes to how companies are valued. And let's just make this really basic, all right? EBITDA is a substitute for cash flow, all right? And we'll break it down even further. And so what's happening whenever anybody wants to invest in a stock of any kind, right? Whether or not it's a whole company or not, what they do is they say, I'm going to pay you money and eventually I'm going to get this money back. And how is it going to get paid back? It's going to get paid back by cash flow. But every company is different. And so therefore we have to come to a measurement where we can make apples to apples comparisons between companies. And EBITDA is that apples to apples comparison. It's earnings before interest, taxes, depreciation, and amortization. And so let's make this really simple in as short a period as we possibly can, right? Earnings, everybody can understand that. How much money did you make? But what's interesting is that we can't necessarily look at net, right? Because, and we're going to take it out of M&A for a second, we're going to say this. Let's just say that you have an 800 credit score, and let's just say that I have a 500 credit score, and we're both going to go get a credit card. Your credit card's going to be at 4% or 5% or something. My credit card is going to be at 20%, right? It's because our risk profiles are different. So if a company has debt on it, the reason why we don't include interest in that EBITDA number, we got to add it back, is because the buyer is probably going to have a different profile and they might be able to finance the business differently. So we add all that interest back. The same thing happens with depreciation. The same thing happens with taxes. They're in a different tax bracket. I'm in a different tax bracket. It has nothing to do with the company itself. It has to do with the capital structure and how we're paying taxes. So what we do is we add all of those things back and we say, here are the earnings before interest, taxes, depreciation, amortization of those assets. And it gets us to an apples to apples comparison. It's not difficult.
Yeah, I love that. And I think that's a great explanation. It really is coming down to finding a way to standardize.
Yes.
Standardize the company regardless of what's going on in their own capital structure.
Yes.
So that we can now say, what is this thing worth to different types of buyers?
Yes.
Yeah, I like that.
Yeah.
And what would you expect would be an average or maybe even a range of EBITDA that are companies that you would normally be working for to sell?
So this is interesting because this goes to the other part of valuation, even outside of staffing. So normally there's going to be two bases for evaluation. It's either going to be EBITDA, cash flow, or if you're in a technology-oriented company, it's going to be what we call ARR. So it's an annual revenue, recurring revenue, right? And sometimes a company is going to be valued on that ARR because they're projecting into the future and they're saying, oh, how much could this company actually have in terms of revenue versus EBITDA? And your EBITDA, the ratio to it, it really does depend on where in staffing your vertical goes. Are you in light industrial, or are you in tech staffing, or are you in healthcare? And so there's no set percentage that goes for any person, but there are industry benchmarks that every owner should be able to look at and say, where do I fall within industry benchmarks? We're sitting here at SIA, they publish these things, so therefore you can actually look at it and say, how am I doing? Am I doing a little bit better than the competitor? Am I doing, or the industry average? Or am I doing a little bit worse than the industry average? But here's the good thing about all this. When it comes to EBITDA, more is better.
Yeah. I love that. That's a great answer. More is better. That's great. That's a great explanation. I appreciate that. So let's talk about timing.
Yeah.
Okay. You know, I think people are constantly trying to time the market, obviously, right? I mean, that's the way that most investors think about things, right?
Yes.
But when timing comes into a play, when you're talking about buying, building, or selling,
Yes.
how does timing affect your work, and how does it, or how should it affect staffing owners' thinking?
Yeah, this is a tricky question because timing, what's the phrase? There's this phrase, make a plan and watch God laugh, right? Because it's like, we'll throw something into it. Let me tell you the sadder part about this is that a lot of companies are going to be sold based on death, divorce, disease, something going on. And so everybody's like, well, I'm going to time the market with this, but you can't time outside impacts, things that are going to impact, that are going to say, well, I need to sell the company now, right? Or I've got a liquidator, I've got to go to it. So now let's get to a more practical purpose, which is the most successful exits are the ones where the founders are prepared to sell the company almost always. Like they have, everything is ready to go. Their financials are ready to go. Their customer inventories are ready to go. You know, their management team is upped and trained and ready to go. And they become what we call the enemy that's not afraid to die. And what that means is that they do not have to do a transaction, no matter what. They can hold this company forever, but they choose to do a transaction. And the difference is now you can start looking at bigger ebbs and flows within the industry and within the economy and pick your exit, all right? And not have to worry about timing it exactly. So 2 points on that. Number one, the most successful exits we see, they are well planned in advance. And number two, instead of timing a particular moment in time, being ready for a range within the cycle.
Yeah, it makes sense. And being comfortable with that range, not trying to overly think it. So really create the culture, create the value in the business.
Yes.
Make sure to come to you and ask you what point should they be thinking about years in advance.
Yeah.
Okay.
It's any investment bank worth its salt. Unfortunately, within our industry, there are people who will only talk to you if you're ready for the transaction, right? And they're like, you're kind of like, move along, kid, move along, right? But the most value is actually derived if you can actually have those conversations a year or two ahead of time, 3 years at a time, at 4 years at a time. I had a meeting today. They're not even going to be ready to sell for 3 to 4 years. And they were like, would you work with us? And I'm like, of course I'm going to work with you. As a matter of fact, I'm dying to work with you because you have this foresight and the objective is going to be better. And so those are clients that are a joy to work with because they can take the advice and they have a longer term vision.
Yeah, love that. That's an excellent answer. So let's talk about consolidation.
Yeah.
What's happening currently with consolidation? I mean, is it a huge play, or is consolidation nothing more than people continuing to aggregate, but this industry is constantly creating new revenue? Like I have a hard time really understanding, truly is there consolidation, or is there just aggregation and then a whole bunch of new revenue continuing to be derived?
It's a little bit of each, actually, right? But the fact that the industry is consolidating And you can tell that just by the count of companies that have more than $100 million in revenue, which is going, it's going up pretty dramatically.
Right?
What is that?
So
right now, what do
you've got a few hundred. You've got a few hundred within, within
North America.
Within North America.
Okay.
Exactly.
Okay.
So just take that as a baseline.
Okay. Couple hundred companies doing over 100 million.
That's exactly right.
And that's proving out consolidation because they're not doing that organically alone.
Not just, but we also see the number of deals that are coming. You usually have a couple hundred deals a year. Some are reported, some are not reported, so some kind of get under. But what you see is that we have, thousands and thousands of staffing companies, thousands of them, right? And most of them are going to be, the vast majority are going to be under $10 million in terms of total revenue. And so what's happening now is at the other end of the market, in that from $10 million to $100 million, there was a session here at SIA today on how to get past the $100 million. And that session was packed full. So that people are in that 40, 50, $60 million range and they're starting to go. Well, when that happens and they go over 100 million, it's a lot easier for the big players to be able to come in and just say, I want to take out that company. We're seeing a lot of activity in that space. Can you find something? We're getting phone calls. Can you find me something 150 million? Can you find me something, 100 million, 200 million? This is what we're looking for. And so the answer to the question is that, there's a lot of benefits too to this consolidation from the perspective of customer consolidation, meaning you've got a small staffing firm that's serving a client in, say, Wyoming, just pick a state, right? But they also have the client also has a location in New Jersey. And do they have the capability of being able to do that? The bigger players are trying to do that.
Got it. Excellent. So really, consolidation is real. It's happening.
It's real.
But at the same time, this is also an industry that has almost no real concentration from a revenue perspective, right?
Yeah, it's remarkable. I mean, the big players are the big players, right? And if we look at it and we say that the blue whales are the only thing that live in the ocean, we're kind of, it's like, oh, look, there it is. It's gigantic. What you don't realize is the tens of millions of little fish that are swimming around it, right? And that's the same thing, is that this industry is it's filled full of smaller fish, but those fish are growing per se, but there's still millions of them compared to the gray whales that are in it.
So Patrick, let's talk about how important culture is to building a company that's valuable, number one.
Yeah.
And using it as a competitive advantage. How do you define it from an investment banker perspective, looking at value creation? How important is culture? How do you define it? And is it something that you spend a lot of time thinking about when you're working with your buyers and your sellers?
Culture is something hugely important because it can erode value as well as make it accretive to value. Bill Taylor, founder of Fast Company magazine, said years ago, your strategy or your culture is your strategy, right? Whatever your culture is, that is your strategy. If you have a culture that's focused in on marketing, that's your strategy. If you have a culture that's focused in on customer service, that's your strategy. If you have, and so whatever you're looking at, collaboration or any other adjective that you want to throw at your culture, that is how you're deciding to compete against everyone else. So what's interesting is that when you start having companies come together in mergers and acquisitions, and you don't take into account what that culture is, it can be extraordinarily disruptive. In the same vein, if they are simpatico, then it becomes a force multiplier in being able to be competitive. Years and years and years ago, we sold a company, and to me, it felt like selling Luke Skywalker to Darth Vader in chains, right? Right? But we were right. And all of a sudden, it's just like, here you go. Those cultures clashed so much that it was just disruptive to everything. And so a lot of times founders will look at an offer, an LOI, and they'll say, oh, this was the best price, or these are the best terms. And yeah, it's fine. But if any part, Paul, of that transaction is based on an earnout or based on, any kind of performance, what you have to realize is that the cultural elements of it are going to contribute to whether or not that founder is going to ultimately get their payout. And so if it doesn't, that money is not going to be forthcoming. And so culture plays a much greater role than most people realize. And from the buyer perspective, I'm going to ask you a question.
Mm-hmm. Please do.
How many cancer cells would you allow in your body?
Oh, I don't want any
Why?
because I don't want one there to even be have the chance to grow.
Because 1 turns to 2, turns to 4,
Yeah.
turns to 8, turns to 16, turns to 32.
There is a multiplier.
It is.
Yeah,
That's
absolutely.
exactly it.
Absolutely.
And so when you start looking at culture and you say to yourself, are there elements, you don't want any of those elements to come in and infect your system per se.
Yeah, that's a great point. So culture is everything.
It is.
Pick a lane, stay with it, and when you're thinking about putting companies together, make sure there's a match.
Yeah. And make sure that your culture is strong enough to withstand it. And if you say, these are our cultural touch points, this is the way that we operate, this is the behavior, this is the way that we treat each other, this is the way that we treat our customers. And if you have those guardrails, it doesn't have to be a checkbox on everything. Oh, it's perfect. It has to be a preponderance that says, okay, these guys are in alignment with us and our culture can strengthen us on this. And this culture that we're bringing in here, they're really strong on those things. And we need a little bit of that and to shine the light on that and bring it forth. So it can actually be very accretive to bring in a culture that has other values as long as you adopt those and bring them in.
Yeah, that's really great great conversation. I love it. How about this as the final thing to talk about today, Patrick? I really want to understand, there's so much noise out there right now. So if I'm a founder, if I own a company that's gained a little, has a little bit of size, and I'm looking at all these different, shiny things, the next shiny toy, and I'm seeing all of this noise, and I'm dealing with the economy and the ups and the downs. Are we growing? If I were you, how would I cut through that noise and make decisive decisions about my next 3 to 5 years? Maybe what are a couple of the points, maybe 1, 2, 3 of the things that I would do to be thinking about now to be decisive about making sure I have a company, whether I want to sell it or not, but I have a company in 3 to 5 years that is valuable for somebody and they're going to want it regardless of what's happening around it.
Yeah, see, so let's start with the toys and the shiny things, right? Because a lot of companies out there have become ferrets. And they run out there and they just grab the shiny thing and they bring it and they hide it in the couch, right? And they go out and they grab another one, they bring it, hide it in the couch. And then all of a sudden they lift up the couch cushion and they got a bunch of shiny things, but none of the things kind of go together. And that's kind of what's happening with AI right now. And that is everybody is running out and grabbing a shiny thing and bringing it home and storing it under the couch and saying, look, we're technology forward. This morning I heard a remarkable keynote speaker down at SIA, and he was talking about avoiding the hype. And I thought, wow, that's the advice everybody should actually understand. What are the 2 or 3 things that you're looking out in 5 years? What are they culturally? What are they looking at from a demographics perspective? What are we looking at from the way the business is evolving? And deciding what it is that we choose to be as a company. Focus in on those things and then decide what shiny toys are going to get you to be that thing. Most of the time, we're so panicked about appearing forward-looking that we actually don't realize that we are not forward-looking because we're just focused in on that instead of the bigger picture.
I love that, and I'm really glad that you
Brought that out. I thought that was actually the most important part of that keynote here at SIA, because I find that most people are talking about AI based out of fear.
Yes.
Not based out of strategy,
Yes.
not based out of, this is something I actually want to add value to my business. It's fear of missing out.
Yes.
And I feel like the AI trend is more FOMO than it is actually pre-planning and future-proofing. So I appreciate that, and you knew what I was talking about. That's a big shiny toy. And I think the other thing that really is very much a distraction, and I'm not to say that AI doesn't need to be implemented in businesses, because I personally believe if you don't implement them in 5 to 10 years, you will be out of business.
I
So
agree.
you have to implement them. However, I find that so many are just solving one little piece of one little problem, and just like, oh, well, let's patch this. So I appreciate that future-proofing. Where do I actually really want to be? And now how do I implement these things to get there? So
That's really a great way of looking at it.
And when you start to realize what market are we serving and how do we serve that market, the tools will become apparent to you, right? And again, it goes back to your culture is your strategy. And if your culture is responsiveness, right? And we are going to answer phone calls this quickly, or we're going to do these things, but here are the tools that allow us to be responsive, all right? Not just getting a tool because it makes us more responsive. That is our competitive advantage. Well, now you're thinking about it the correct way.
Yeah,
Completely agree with that. Well, that's excellent. I'm sure those things that you're giving advice to your clients about. I'm sure you're helping them make sure that their businesses are future-proof. I love the specific example you gave of somebody who's thinking 3-4 years in advance. I think that's just brilliant. And you taking the time to do that really does set you out of the pack. Because I love all my investment banker friends, but many do not take the time, like you do, to be able to make sure that somebody is really shooting for something that's going to be valuable. So I appreciate that about your personality.
I appreciate the nice thing that I would say even about our bank, and it's not a plug at all, it's just a thing. All of our senior bankers have started, built, and sold their own companies. All right? So we're looking at the world a little bit differently. We're looking at that founder's journey and saying, yeah, we've swept payroll. Yeah, we've had to make financing decisions. Yes, we had to, what is our cap structure going to look like? Yes, we don't. So there's very few things that a founder could throw at us that we don't already understand and, more importantly, empathize with, and saying, God, I understand where you are because I've been there myself. And it changes the dynamic of a transaction, because that empathy allows us to know when we have to be gladiators on behalf of the client and say, no, we have to have this thing, and when we can kind of tap the brakes and be able to say, no, we can give on this point. Very different perspective.
Yeah, I love that. And it's funny, you've said that word a couple of times, and I'll add one other thing. I just think it's so interesting is that the successful people that I enjoy being around, the successful people that I enjoy interviewing and talking to, bring in some of those qualities that are very universal and require stepping back and looking at it, kind of the morality of humans. And there's two that jump in my mind, are the top two, and that's humility and empathy. 100%. And when you understand that being successful in business and in life requires those two beautiful things, empathy and humility, it really truly makes very successful people that you actually enjoy helping out and working with. And so it's a beautiful thing.
I think that humility is a superpower.
Me too.
I really do. I think the ability not to self-aggrandize, the ability to and by the way, tying it back to the top of the interview, right? That comes from travel. Comes from travel. My son is 22 years old. He has seen 34 countries in the last couple of years. And one of the things I said to him, I said, what have you learned? And he goes, the biggest thing I learned was when I was in Thailand. He was there studying Muay Thai. He said, they have nothing. The average person in Thailand, he goes, they have nothing. They go to their food stations at 5 a.m. and they work till 11 o'clock at night and go home and come back. And he goes, Dad, they're the happiest people I've ever seen. Everybody's smiling. Everybody is glad to be with one another. He goes, I've never been in a more happy place. And you look at that and you say, why is that? And it is because they appreciate what it is they have, and they have humility. They're not comparing themselves to everyone else. Those are the types of people that it's a joy to serve.
I agree with you 100%. Well, that's beautiful. I love how simpatico we are about that. Stay humble, stay empathetic, enjoy our businesses, enjoy the people we help out. Don't lift ourselves up and just prop ourselves up, but being able to be down there and help people out, it gives us so much quality of life that really is enjoyable. Yeah. So it's always an absolute privilege to have you on the Growth Game podcast. Patrick Morin from Transact Capital, thank you, my friend. Appreciate it very much, and many continued successes.
Thank you very much, Paul.
Absolutely, thank you. Well, that's another wrap from the Growth Game podcast live at SIA in Austin, Texas. Until next time, audience, it's a wonderful privilege to be able to be together today, and we will see you at the next event.